Hi investors. Most of the traders suffer losses while investing due to two reasons. First, one, lack of knowledge, and the second reason is the entry point. Most of the traders chase a breakout stock and take entry in the upside. After that, the stock will come down for retest or false breakout. So today we are giving you 4 chart patterns that any investors can check for potential entry for positional trading. These chart patterns have a success ratio of more than 90%. So without wasting time, let's get into the video. The first chart pattern we are going to discuss is ascending triangle. An ascending triangle is considered as a bullish signal. It indicates a possible continuation of the current uptrend. In ascending triangle, the lower trend line is rising and the upper trend line is horizontal. This pattern occurs because the lows are moving increasingly higher but the highs are maintaining at a constant price level. The pattern will have 2 highs and 2 lows, all touching the trend lines. This pattern is confirmed when the price breaks out of the triangle formation to close above the upper trend line. Volume is an important factor to consider. When the breakout occurs, there should be noticeable increase in volume. If the volume is not there, investors should be cautious. The triangle is a short-term pattern. It may take 1 and 3 months to form. The longer the pattern, the longer it will take to reach the target. The shorter the pattern, the sooner the price move. The target should be a potential return of greater than 5%. Also, we should check the region of support and resistance at the lows and the top of the triangle. The prices should be above 200 moving averages. When the price is close or higher than 200-day moving averages, the signal is considered as strong. This pattern with its increasingly higher lows and constant highs indicates that buyers are more aggressive than sellers. The pattern forms because a supply of shares is available at a fixed price. When the supply depletes, the share quickly break out from the top trend line and move higher. The bullish flag chart pattern is a continuation pattern commonly observed in technical analysis. It is characterized by a brief consolidation period that occurs after a strong upward price movement, forming a rectangular-shaped flag. The flagpole represents the initial price surge, while the flag itself represents the consolidation phase. Here's a breakdown of the components of a bullish flag chart pattern. Flagpole. The flagpole is the initial strong upward movement in price that precedes the formation of the flag. It typically consists of a sharp and rapid price increase, often accompanied by high trading volume. Flag. The flag is a rectangular-shaped pattern that forms after the flagpole. It is characterized by a slight downward or sideways movement in price, which indicates a temporary pause or consolidation. The flag pattern usually has parallel trend lines that act as support and resistance levels. Breakout. Once the flag pattern is formed, a breakout occurs when the price breaks above the upper trend line of the flag. The breakout is typically accompanied by an increase in trading volume, confirming the continuation of the prior upward trend. To estimate the potential price target of a bullish flag pattern, you can use the flagpole as a reference. Here's how you can calculate a rough approximation of the target. Measure the length of the flagpole. Start by measuring the length of the flagpole, which is the distance from the beginning of the initial upward move to the top of the flagpole. This measurement represents the magnitude of the price increase that led to the formation of the flag. Project the flagpole length. After measuring the flagpole length, you can project it upward from the breakout point. The breakout point is the level at which the price breaks above the upper trend line of the flag. Add the projected length to the breakout point. Take the length of the flagpole and add it to the breakout point. This sum represents a rough estimate of the potential price target. Determining a suitable stop-loss level for a bullish flag pattern involves considering factors such as risk tolerance, market conditions, and the specific characteristics of the pattern. While there is no definitive stop-loss level, here are a few common approaches that traders may use. Support level below the flag. Identify a support level below the flag pattern where the price has previously shown a significant level of buying interest. Placing the stop loss slightly below the support level aims to protect against potential downward price movements that could invalidate the pattern. Trendline support. Draw a trend line that connects the higher lows within the flag pattern. Place the stop loss slightly below this trend line to protect against a potential breakdown. Percentage-based stop. Determine a percentage of the flagpole's length and subtract it from the breakout point. For example, you may choose to set a stop loss at a certain percentage, 1% or 2%, below the breakout point. This approach considers the magnitude of the flagpole's move and aims to protect against excessive retracements. Volatility-based stop. Calculate the average true range, ATR, or use other volatility indicators to gauge the average price range over a specified period. Set the stop loss a certain multiple, 1x or 2x, of the ATR below the entry point, taking into account the market's volatility. The double bottom pattern is a bullish reversal pattern commonly observed in technical analysis of financial markets, such as stocks, currencies, or commodities. It is characterized by two consecutive troughs, or bottoms, on a price chart, separated by a peak, or a smaller rebound, in between. The pattern is considered complete when the price breaks above the peak formed between the two bottoms. Here are some key characteristics of the double bottom pattern. Formation. The pattern begins with a downtrend, where the price reaches a bottom, trough, and bounces back, forming a temporary peak. After the rebound, the price declines again, often with lower volume, and forms a second bottom at a similar level to the first one. The two bottoms should be roughly equal in height, although some minor variations are acceptable. Confirmation. The pattern is confirmed when the price breaks above the peak that formed between the two bottoms. This breakout signals a potential trend reversal, indicating that buying pressure may be increasing, and further upward movement is likely. Volume. Volume analysis is an important aspect when identifying the double bottom pattern. Typically, there is a higher volume during the first bottom formation, followed by lower volume during the second bottom. As the price breaks above the peak, there should be an increase in volume, validating the breakout. Price target. To estimate a price target for the pattern, measure the vertical distance from the lowest low, bottom, to the peak between the bottoms. Then, add this distance to the breakout point. This projection can provide an approximate target for the subsequent upward move. Pullback. After the breakout, it is common for the price to experience a pullback, where it retraces to test the breakout level. This pullback provides an opportunity for traders to enter long positions with potentially better risk-to-reward ratios. To estimate a price target for a double bottom pattern, you can use the technique of measuring the vertical distance between the lowest low, bottom, and the peak formed between the two bottoms, and then projecting that distance upward from the breakout point. Here's a step-by-step guide on how to calculate a price target for a double bottom pattern. Identify the breakout point. The breakout point is the level at which the price breaks above the peak formed between the two bottoms, confirming the pattern. Once the breakout occurs, note the price level at which it happens. Measure the pattern's depth. Measure the vertical distance between the lowest low, first bottom, and the peak formed between the two bottoms. This distance represents the pattern's depth. Add the pattern's depth to the breakout point. Take the depth measurement obtained in step 2 and add it to the breakout point identified in step 1. This will give you an approximate price target for the subsequent upward move. Determining a stop-loss level for a double bottom pattern depends on your individual risk tolerance, trading strategy, and the specific characteristics of the pattern you are observing. Here are a few approaches you can consider when setting a stop-loss for a double bottom pattern. Below the second bottom, a common approach is to set the stop-loss order slightly below the second bottom. This allows for a buffer in case the pattern fails and the price continues to decline. The idea is that if the price falls below the second bottom, it may indicate a failure of the pattern and a potential trend continuation in the downward direction. Percentage-based stop loss. Another method is to set a stop loss based on a certain percentage below the breakout point or the pattern's depth. For example, you could choose to set the stop loss at a level that represents a 2% or 3% loss from the breakout point or the depth of the pattern. Volatility-based stop loss. You can also consider using volatility indicators or average true range (ATR) to set a stop loss level that accounts for the stock's or market's volatility. A wider stop loss may be appropriate for a more volatile stock, while a narrower stop loss could be used for a less volatile stock. Moving averages. Some traders use moving averages, such as the 50-day or 200-day moving average, as a reference for setting stop loss levels. They may choose to place the stop loss below the moving average to ensure they exit the trade if the price falls below the average. Personal risk tolerance. Ultimately, your stop loss level should align with your risk tolerance and trading plan. Consider the amount of loss you are willing to tolerate on a single trade and set your stop loss accordingly. The inverse head and shoulders pattern is a technical analysis pattern commonly used in trading and investing. It is the opposite of the regular head and shoulders pattern and is considered a bullish reversal pattern. In the inverse head and shoulders pattern, there are three main components: the left shoulder, the head, and the right shoulder. The pattern forms after a downtrend and indicates a potential trend reversal to the upside. Here's a breakdown of the components. Left shoulder. The left shoulder forms as a low point in the price chart during a downtrend. It is typically lower than the previous low in the trend. Head. The head forms as a lower low than both the left shoulder and the right shoulder. It represents a significant bottom in the price chart and is the lowest point of the pattern. Right shoulder. The right shoulder forms as a higher low than both the head and the left shoulder. It is generally lower than the previous high in the trend but higher than the head. The pattern is completed when the price breaks above the neckline, which is a resistance level connecting the highs of the left shoulder and the right shoulder. This breakout is a signal for potential bullish momentum, and traders often interpret it as a confirmation of the pattern. The inverse head and shoulders pattern suggests a shift from a bearish trend to a bullish trend. It is used by traders to identify potential buying opportunities, and they may set price targets based on the pattern's height projected from the breakout level. Determining the target for an inverse head and shoulders pattern involves measuring the pattern's height and projecting it upward from the breakout level, the neckline. Here's a step-by-step process to calculate a potential target. Identify the neckline. The neckline is a horizontal line that connects the highs of the left shoulder and the right shoulder. Measure the pattern's height. Calculate the vertical distance from the lowest point of the head, the bottom of the V, to the neckline. Project the height upward. Once the price breaks above the neckline, add the pattern's height to the breakout level. This gives you a potential target for the upward move. Determining the stop loss level for an inverse head and shoulders pattern involves identifying a price level that, if reached, would invalidate the pattern and suggest that the bullish reversal is not occurring as expected. Here's a general approach to setting a stop loss for an inverse head and shoulders trade. Locate the neckline. The neckline is a key level in the pattern. It connects the highs of the left shoulder and the right shoulder. Determine the breakout level. The breakout level is the point at which the price breaks above the neckline, confirming the pattern. This is the level at which you would enter a long buy position. Set the stop loss below the neckline. To protect against potential losses, consider placing your stop loss order slightly below the neckline. This level acts as a safety net in case the price fails to sustain the expected bullish move and falls back below the neckline. The specific distance between the neckline and the stop loss level will depend on factors such as your risk tolerance, the volatility of the asset, and the time frame you are trading. Traders often use techniques like setting a fixed percentage or a specific number of points below the neckline to determine their stop-loss level.